CNBC-TV18.
Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into the financials and tell you about the key risks and triggers going forward. So let's not waste any time and get to our first stock today. My colleague Nigel D'Souza gets us this very special deep dive into Itd Cementation.
Inside Out on the Road is back and we're at the corporate office of Itd Cementation here in Mumbai to get some insights on how things are shaping up on ground. Now, Itd Cementation has been a stock with plenty of interest in 2022 as it's outperformed the benchmark indices smartly. However, in the past 5 years, it's been a rank underperformer. The street is now pinning its hopes on a couple of good years for the company, and we'll hear from them in just a bit. Well, the company is a leading EPC company with over 9 decades experience in India in executing heavy civil and infrastructure projects across a whole host of segments such as urban infra, highways, maritime structure, among others. The company has strong parentage with the Italian Thai development public company holding 46% stake in the Indian listed entity. Out of the total order book of the parent, a fourth of it is attributed to this Indian listed entity. Well, in FY23, the order intake has been very strong with more than 7,000 crores of order inflows, bulk of it being attributed to a 6-laning road project in Uttar Pradesh amounting to around 4,850 crores. The order book position was stable around 10 to around 11,000 crores, but now it's standing tall at around 21,000 crores. Out of the total order book, 70% comes in from 3 big sectors. That's urban infra and airports, they constitute close to 30%, highways and flyovers account for around 22%, and maritime structures accounts for close to around 20%. Now, breaking down their business further, the government of India as well as PSUs, they account for around 60%. But they have been awarded a large order, which is the Adani Ganga Expressway road project. That's part of their private portfolio, which stands at around 37%. Moving to their geographic breakup, well, it's skewed towards Tamil Nadu, Uttar Pradesh as well as Karnataka. At current reckoning, its order book to sales ratio is looking quite good at around 5 times. And execution has been picking up as well, which is evident in their quarterly run rate. But the street is now hoping that number could inch up to around 1,500 crores per quarter. However, margins got diluted in the past quarter as some legacy orders were executed, and a rebound from here will be extremely crucial for the stock. Now, the total debt in the books, that's the long as well as the short term put together, is around 500 crores, which is fairly manageable. And since its promoter is MNC, well, it has zero pledge in its books. The big question is, can they do 6,000 crores of sales with double-digit margins in FY24? To understand that and more, let's get straight to the management. Well, Mr. Basu, thanks so much for speaking to us here on CNBC-TV18. There's plenty to talk about with regard to the company, but first up with regard to the industry. The theme has been that the next 10 years belong to India with regard to the infrastructure theme. Do you see that sort of traction on ground? And are you in the camp that believes that, yes, the next 10 years will be very good for the infrastructure space here in India? Go ahead, sir.
Nigel, thank you very much for coming here. And I purely agree with your view, whatever you have said. If you see in construction space, the business will be around 600 billion per year, which is 1,50,000 crores in construction industry we do business, which is next to agriculture. And such a big area, the contractors, if you see the players are very less.
Right.
L&T, ourselves, Afcons and few others. So there is plenty of opportunity to grow. At the same time, there is a huge emphasis from the government of India to invest in infrastructure.
Right.
You see the pipeline in construction industry is around 1.5 trillion, which is a huge number. So as you rightly said, I strongly believe that there is a huge scope for us to grow in infrastructure segment.
Okay, all right, we got that. So India is on a good path with regard to the infra space. But let's talk about Itd Cementation. The first half of the year, you have actually done very well with regard to bagging orders.
Yeah.
Close to 7,000 crores odd.
Yeah.
But what the market will want to know is, what is the second half of the year looking like? What should the total order inflow for the year look like? And also, if you could give us a sense, about how much of that is L1 positions as of now. Go ahead.
Well, before I answer to a specific question, I strongly believe that increase in revenue is a big factor to our bottom line. There are many theories behind that. So the order book is now around 7,000 crore. We have secured 21,000 crore.
Yes.
And we are L1 of almost 3,000 crore, which are overseas business, and 17,000 crore of work under pipeline in tender stage. So I believe 10,000 crore at least order will be secured by us in this year.
Okay.
And if you see the legacy order, yes, there are some legacy orders.
Put a number to that, sir. Because the fear is that yes, the order book is looking good at close to around 21,000 crores approximately.
Yes.
You're telling us that for the year, the order inflow will be close to around 10,000 crores.
Yes.
But how much of this order book as of now is legacy orders? The reason I ask you this is because that will attract lower margins.
Yeah.
So give us a sense as a percentage of your order book, how much of it is legacy?
Around 4 to 5%. 4 to 5% will be having no margin at all,
Okay.
or very less margin.
Okay.
Yes.
So, break it up for us then, since we just spoke about that. So you're saying close to around 1,200 crores will be legacy orders where you won't make any margins at all.
Yeah.
But there'll be still some orders where you'll attract relatively lower margins in low single digits.
Yes.
So as a percentage of this 21,000 crores, could you put a number to that? Is it 30%? Is it 20%? What is it?
See, 50% of our order book is from urban infra and marine.
Right.
We generally fetch better margin.
Okay.
When I say better margin, 11%, 12%, 13% in that range. Balance 50% airport and other industry will be around 6 to 8%.
Okay.
So you can get a sense out of that, what should be the margin.
Okay. And currently, as a percentage of your total order book, as you said, urban as well as maritime,
Yeah.
they account for close to around 50% of your order book, right?
Yes, yes.
Where do you see this contribution headed in the time to come?
Well, marine will be, obviously will be more very soon, as I said that 2 big jobs we are pursuing. So I think both together will be around 60 plus or % plus by another 2-3 months time.
And international business, at least as of the numbers that you've already declared,
Yeah.
it's a very minuscule part of the listed entity currently.
Yeah.
But tell us, you must be the very fact you're talking about winning orders in Bangladesh, talking about various other Southeast Asian countries, Sri Lanka as well in there. Do you have a target that the international business starts contributing a greater deal to the total revenues? And also briefly tell us, it's better margin business. Payment terms are better as well for international business?
Yes. 3 years back, we took a challenge that we should go into international business, which was not allowed by our parent before, because they are already present in the international market.
Correct. So,
So it was a conflict of interest.
Right.
like that. So now when we have secured one job in Myanmar for Adani Group, we did very well. And they believe that we can do well in other business in the international as well.
okay. So the reason that the reason that you're telling us that you all haven't gone ahead and bagged many international orders till now is because there was a conflict of interest, the parent entity as well.
Exactly.
Okay. But going ahead, you're saying that that business has potential.
Yes.
So what should be the targeted mix then going ahead from the international business?
Today it will be around 15% of total order book, and we are targeting to go to 30% by next 2 to 3 years time.
Okay. And you want to clarify whether or not it's better margins, better payment terms. Is that the case, or is it?
See, it can go wrong as well, but we are very choosy in terms of whenever you go for international business, first and foremost the location and the client should be known to us.
Yeah.
And there are a lot of project export is happening by the government of India through Exim Bank. So we only target those projects where government of India is funding and part of the payment will be received at the India.
Well, Mr. Basu, you're sounding very, very optimistic about the future. You're currently going at a run rate of close to 1,000 crores per quarter.
Yeah.
My question to you is, for the second half of the year, what kind of a quarterly run rate are you looking at? And from there on, when do you see it scale to say 1,500 crores per quarter?
First 2 quarter was almost 1,000 crore. Even second quarter, though affected by the monsoon, was close to first quarter. Going forward, third and fourth quarter of this year, should be around 1,400 crore to 1,500 crores.
So is it safe to assume that for FY24,
Yeah.
if I just try to extrapolate these numbers
Yes.
and 1,500 crores run rate per quarter, should you be ending FY24 with a number of closer to around say 6,000 crores? And given that legacy orders are quite small and your mix is changing, should you go to double digit margins? If yes, what kind of a margin number you should work with? Go ahead.
6,000 crores is quite achievable next year. The order backlog what we have, and if you do not achieve 6,000 crore, we will be defaulting. And at the same time, double digit margin also is quite possible, 10%, 11% in that range.
I didn't get the points about the 6,000 crores you'll be defaulting. Why do you say that?
See, the time cycle of the contract in civil engineering construction field is around 3 years time.
Right.
So if you think that 21,000 crore is our order book, you have to complete in 3 years time.
Okay.
So by simple mathematics, you should do 7,000 crores.
You're right.
So if you don't do 6,000 crores,
Then
you'll be
you-
delaying the project and you'll be defaulting. You'll not be able to complete the job in time.
So 6,000 crores at least is what you're expecting?
Yes.
This year you end, if I put in the numbers, you end closer to around 4,800 crores. And next year you do around 6,000 crores. What about FY25? Do you have a projection out there?
We have a projection. I think for next 2 to 3 years time, it should grow at the rate of 25 to 30%.
Okay.
Yeah.
With double digit margins.
Yes, we hope so.
Okay. Now for a construction company, you normally look at the debt number.
Yeah.
And as the order book inflates, you'll pick up in execution as you're promising.
Yeah.
Your debt number, long term and short term together, currently I think is around 500 crores.
500 crores.
Where do you see that number headed at peak levels? Point number one. And what is your targeted working capital days that you're looking at?
So far, we have managed very well as far as the debt is concerned. For a size of our business of 4,000 crore, you can check in the market, debt will be not less than 1,500 crores, where it is only 500 crores here. Definitely, with large volume of work has to be done next year or so, our debt will increase little bit. I think it will go by another 2 to 300 crores next year. At the same time, a lot of capex investment will be there to purchase some new machines and plant and equipment. So around 200 crore increase you can expect in the debt next year. Yeah.
And what about working capital days?
See, our focus is always to collect money as quickly as possible, and so receivables should be as less as possible, and that is already demonstrated in our balance sheet. So working capital, we will be happy to have it within 100 to 120 days.
So just to focus on FY24, you're telling us you'll do 6,000 crores at least, double digit margins.
Yeah.
Peak debt will be around 800 crores
Yes.
and working capital days will be maintained sub 120 days. Are we
100,
getting all of that correct?
Yes.
I have a counter question on the debt part.
Yeah.
You have only 500 crores of debt in your books,
Yeah.
but your interest that you're paying every quarter is 40 crores.
Yeah.
Explain that to us. Why should it be so high? There'll be other components in that 40 crores because otherwise, I annualize it goes to around 160 crores on a debt of close to around 500 crores as you're saying. So explain that to us.
Actually, there is a, it is 500 crore debt from the bank and the bankers. But we also have a lot of advances from the client,
Okay.
which you today will be around 700 crores. And those 700 crores, part of that, most of the 700 crores attract interest at the rate of 9 to 10%. So whatever you have seen that interest cost, part of that is from the bankers, part of that is from the client. And then third component is the LC charges and BG charges. So put all these three together, the number is looking little high.
The other factor that works in your favor for some, at least for some analysts, is that you have foreign parentage, MNC company. Now, you pay some part of it as royalty. I think it's close to around 0.5%.
0.5% of the sales.
0.5% on sales. When does that come up for renewal? And is there an upside risk to that number of close to around 0.5%? And also tell us, what do you all gain from this, by paying the parent royalty? Is there some, technical know-how or something special that you all get from the parent?
Yeah, I'll answer your last question first. First of all, our parent, the Itd, they took over in 2003. And if you see the segments we are working now, it is mostly because of them. They taught us how to do the tunnel boring. They taught us how to do the airport. So the niche area we are today because of their help and their support. And even today also, all the metros where we are working in tunnel boarding machine, there are Thai nationals there as an operator, as a helper, as foreman, superintendent. Without them, it is difficult for us to work. So there is a huge technical support we always gain from the parent company.
Okay, so you believe this 0.5% is justified?
Justified, and I don't think there will be any changes because every year it is getting renewed at the same percentage for several years.
The other question is, if the parent is so confident and you're saying that things are going to look up from here, I recall you raised some money from the market a few years ago,
Yes.
and the promoter holding got diluted.
Yes.
It's currently around 46%.
46%.
Does the promoter entity have any intention? You know, normally a promoter wants to hold more than 50% in a company.
Yeah.
Any indications from them?
Well, we needed some money few years back, and that is how promoter has helped by diluting their stake. Now it's a big conglomerate. They have got many other businesses. So specifically for us, what policy they will adopt, that is governed by their general policy of the company. So definitely we like them to invest more, to take more stake, but I will not be able to say definitely for sure that what is there in mind.
But you could tell us what is their outlook with regard to the Indian, infra space itself. Suppose they get a good offer, do you think that they'll be sellers?
No. They are very much happy with our performance, and we have one of their entity where we are doing well, and that is how I had just mentioned to you, they are allowed us to go overseas. They are quite happy with our performance.
Okay, all right. It's been a pleasure talking to you, Mr. Basu. Thanks so much for joining in on Inside Out.
Thank you for your time.
All right, that was a deep dive into Itd Cementation, but time to slip into a short break. We'll come back with another interesting stock. PB Fintech is in the spotlight on the other side.